Hello everyone, welcome to Just Invest Today, and today we're going to be talking about one of the best articles on investing, in my opinion, because this gives you direct insight on who really does the best in the market. So we're going to get into this. So basically this is a Fidelity article on basically they're trying to find who were the best investors. And the study was done from 2003 and 2000 to 2013. And basically Fidelity is a brokerage firm with a lot of assets under management, and they have all these sorts of products and investment tools and research that you can do and research firms and all that type of stuff. So they wanted to see who did the best in their investment accounts. So they did a study, right? So let's read this. A news item that had gotten a lot of attention recently concerned an internal performance review of Fidelity's accounts to determine which type of investors received the best returns between 2003 to 2013. The customer account audit revealed that the best investors were either dead or inactive. The people who switched jobs and forgot about their old 401k, leaving the current options in place, or the people who died and the assets were frozen while the estate handled the assets. The next big performers were those with energy, healthcare, and small cap value portfolios. So guys, you can see that the best investors since 2003 to 2013 were either dead people or people basically who just forgot about their accounts. That just shows you how much you got to ignore the news and ignore everything around you. So guys, so this goes back to my theory, one of my theories on why this happened, right? Basically, people's temptation is killing a lot of people's gangs. What I mean by this is that people just think good in investing means your stock is going up, right? So they associate the bad with your stock going down. But what you really got to think of it is the opposite. If you're able to think sometimes that your stock going down and you're confident in the stock going down is actually a good thing because you can buy at cheaper prices, right? And if you're thinking long term, you're going to hold this stock for 10 years, you always want to buy stuff cheaper. Why wouldn't you want to buy the stock that you're going to love and own forever at a cheaper price than a more expensive price? So when people associate within the stock market stock going up is good, when your stock goes down, majority of people are risk averse. So they don't like when their stock goes down. And losses hurt more than gains. When you get a gain, you're just like, okay, it's pretty good, it's amazing. But when you suffer a paper loss, actually you just see your account going down, but you didn't actually like cash it out or anything. When you see that loss in your account, it hurts so much more than if your account goes up and you gain like 2x, right? So when people see that huge loss, they immediately sell out because they think they did something wrong. They didn't understand their company, and they probably think they did the research wrong, so they get out of the market. And then exactly when the company is back on fire or going back up, they put their money back in. So guys, you can just see the problem with that, guys. You're not buying low and selling high. You're doing the complete opposite. So that's my theory on one of the reasons why. And then my second reason why is that when your stock goes down, there's always so much news and media attention on your stock and on the market and what's going to happen in the future. So when there's always doom and gloom about what's going to happen in the future, you're going to be rushing out of the stock market thinking you can time the market, right? So when you think you can time the market, you do all these bad buying and selling and buying, and you're just doing all this random stuff. And then if your predictions are wrong, that you think the stock market is going to crash, and then the opposite happens, everything just goes up. You literally miss all those gains, and then you put your money at the very top of that market. And then you just do it again. It goes down a little bit, you sell out, and then you buy when the stock is going up because you think that's good going up. The stock going up is good. So you can see how this just leads to huge losses instead of just relaxing, buying at your price, and just staying into the market no matter what it's doing because 5 to 10 years this company is going to be big and you're not taking any capital gain taxes, no losses on your capital, and that's what we want. We just want to hold these strong companies in our account. So guys, tell me, what other theories do you have on why people who were actually dead actually in their accounts, or people who forgot about their accounts, actually did the best in these markets? Tell me what you think. Guys, if you like this video, like it, subscribe to my channel. I'll get back to you in the next video. Peace.